The country that is synonymous with oil wants to be a major player in energy transition. EV Metals Group is building a massive battery metals processing facility in Saudi Arabia. CEO is Michael Naylor. Michael, welcome to Kitco.
Good day, Michael. Good to be with you, and thank you for the opportunity to speak to you.
Tell us what you're building in Saudi Arabia, Michael.
Well, we start with EV Metals Group that is building a global battery chemicals and technology business. So we're focused on the development of the world's first integrated battery chemicals complex at Yanbu Industrial City in the Kingdom of Saudi Arabia. The battery metals complex will consist of a lithium chemicals plant, a nickel chemicals plant, and most important of all, the cathode materials plant. The nickel chemicals plant and the lithium chemicals plant will supply high purity chemicals to the cathode active materials plant, which will produce cathode active materials in the form of high energy density cathode active materials, which contain lithium, nickel, manganese, and cobalt, and lower energy density cathode active materials, which is of particular note in current market conditions. That's lithium ferrous phosphate, otherwise known as LFP.
Now you're covering the whole range, it looks like there. In your presentation, talking about what you're building, Michael, you saw an opportunity because you said that upstream chemical companies just seem to be unwilling to invest in the space. I think about Johnson Matthey, who exited the battery materials biz. Why are they not in the space, Michael?
Look, that's a really good question. I mean, Johnson Matthey we respect as one of the world's leading chemical companies. To answer that, firstly, the chief executive of Johnson Matthey noted in his commentary about the disposal of that business that he saw lithium, nickel, manganese, cobalt, if you like, the chemicals that are required for cathode active materials, growing in volumes to the extent he saw them as becoming commodities. That's his view. We hold a different view. These chemicals are specialty chemicals, if you like, pharmaceutical grade chemicals. They will never be a commodity. They'll always be a product. And around that, you need to look to developing products specifically targeting the growth areas in the market. And they are nickel, cobalt, manganese, and lithium for high energy density, and lithium iron phosphate for lower energy density batteries. The ELNO cathode material that Johnson Matthey developed was brilliant. High energy density, but at the end of the day, there's no market for it. And in that context, to be fair to JM, when they started out that exercise, I think over 8 years ago, it was difficult to predict at that time exactly where battery chemistry or cathode chemistry was heading. But it's in this business, you must be able to adapt as you see markets changing. And look, we've made a change in the last 6 months on our strategy for cathode active materials in response to what we see as very significant changes in the market.
Where will you get the raw materials, Michael?
Well, we're uniquely placed. And let me answer a question you raised just before in that last. You said that chemical companies were not invested in the upstream supply chain, or words to that effect. I think the point you're raising is this. Our market research has shown us that major chemical companies outside of China are unwilling or incapable of investing in the upstream supply chain. And there are very good reasons for that. I mean, these companies are typically 50 to 100 years old, and never in their business model have they looked to go upstream, that is, participate in mining, processing, and production of intermediate product that they would otherwise buy on market or have historically bought on market. And this is where the world is changing. Going forward, our market intelligence is showing us that ultimately, original equipment manufacturers such as electric vehicle companies, battery cell manufacturers need upstream supply, or integration of upstream supplies to enable them to access critical raw materials long-term on a transparent, cost-managed basis. And this is where they're exposed. At this point in time, major electric vehicle companies, with relatively few exceptions, are completely exposed to escalation in the prices of metals that are contained in the chemicals. And ultimately, if you want to build an electric vehicle business long term, you must work on a long-term supply chain from source. And that's the gap that we see in the market. So when we look to talk to companies about offtake agreements, we're looking to talk to electric vehicle manufacturers to help them understand the supply chain, and battery cell manufacturers, Michael. So that's taking up your earlier point.
I want to add on to that, Michael, because I think there's another factor, and it's just Australia. Australia has been so aggressive in the battery metal space. You're based out of Australia. I think about what happened in Canada with BHP and Andrew Forrest, Wyloo duking it out over Noront. Never mind the fury of deals and the offtakes that you had in 2021. What's going on in the country that is so bullish on battery metals, Michael?
Again, a good question. Let's look at BHP and Wyloo and Noront. I think it's fair to say Australia is aggressive, and there are good reasons for that. We offer globally stable, long-term, transparent supply chains. And that's important, especially in growth markets in Europe and North America. About Noront specifically, in BHP and Wyloo, yes, are engaged in a fight over that asset. For me, it's a bit like seagulls fighting over a chip. The bottom line is that Noront is a relatively small nickel deposit. Our market intelligence and research is telling us that by 2040, world demand for nickel in electric vehicles is approaching 4 million tonnes of nickel a year. I mean, new mine production at the moment is between 2.5 and 3 million, depending upon who you read. But ultimately, we don't believe that there are enough nickel projects in the pipeline to supply that demand. And that's why we are saying that there are specific targets we have for nickel. We're growing nickel inventory now. I mean, the nickel price is, I think, running at around $20,000 a ton, and that's good. But we don't want to see it at $50,000 a ton. I mean, we must think like and get the model right around what electric vehicle manufacturers need to sustain growth plans. And that's about looking globally now. And if you want to see this transition to electrification and a clean energy future, we can't afford demand destruction because we can't supply the critical raw materials. And here's where globally we need to get together to look at this, because otherwise the growth plans of both electric vehicle manufacturers and battery cell manufacturers will stumble, some will fail. I mean, for example, let's take a battery cell manufacturer that's recently been established. If you audit his supply chain, understand what the longevity looks like in his offtake agreements. Is it 5 years? Is it 10? No, you need 25 to 50-year offtake agreements. And of course, that requires companies like the one being developed by EV Metals and the Kingdom of Saudi Arabia that go upstream, invest in the upstream supply chain to ensure long-term, stable, low-cost supplies of raw materials to OEMs. Remember, each player you have in the value chain takes a margin. Our business strategy and model is to speak to electric vehicle manufacturers and say, look, we have the supply chain covered all the way through to CAM. The battery cell manufacturer should just take a margin on the manufacturing of the battery cell, not on the critical raw materials or high purity chemicals in it. So again, it's logical to speak to electric vehicle manufacturer to show him how the supply chain works, where the cost structure of the supply chain sits, and negotiate long-term contracts that gives him control over his critical inputs to battery cells, which I think represent about 40% of the cost of an electric vehicle.
Where will you be getting the raw materials to feed your plant, Michael?
Well, firstly, we're building the battery chemicals complex in the Kingdom of Saudi Arabia. Yanbu Industrial City is strategically located for importing intermediate product for downstream, midstream and downstream processing, and of course exporting the high purity chemicals and cathode active materials into North America and Europe. Look, the best place in the world to obtain spodumene concentrate nickel intermediate product and other metals is Western Australia. We are the world's largest producer of spodumene and the largest exporter of spodumene concentrate in the form of SC6 or 6% lithium oxide contained in the concentrate. At this point in time, Michael, over all of our states' production of spodumene concentrate is under the control of offtake agreements with Chinese chemical processing companies. So with that, equally importantly, we're the largest nickel producer in Australia. We have the critical raw materials in situ. Western Australia is a state with politically stable, it's low sovereign risk, and being the leader of spodumene production globally and a state in which we've got considerable resources, it's a natural fit, a strategic fit for supplying transparent, low cost and stable raw materials, both to the battery chemicals complex in Saudi, but more importantly, the high purity chemicals and cathode active materials required for growth in Europe and in North America. So with that, something we announced recently that has largely passed unnoticed is that we launched the Australian Lithium Alliance about 3 weeks ago. And I guess, to use your turn of phrase, that is an aggressive step. That's an initiative on the part of EV Metals Group to partner with Australian companies to accelerate exploration for mining and production of lithium. The lithium market is headed for structural deficits in the back half of this decade. And look, unlike battery manufacturing plant, battery cell manufacturing plants that could be built in 2 years, developing a major resource project takes 5. We're in the business of fast-tracking development for speed to market. So the Australian Lithium Alliance is about offering emerging lithium producers in Western Australia, and I'll come to your earlier question now, an alternative to Chinese processing companies for offtake agreements with spodumene production. It's unique. In fact, we stand in Australia now as the only company in a position to offer that because we're building out 2 trains of lithium hydroxide monohydrate in the kingdom as the first stage of our battery chemicals complex. We, of course, have 4 trains planned, and the demand projections that we're seeing would suggest that we need to go to 6 trains. And of course, the Royal Commission of Jebel and Yanbu will accommodate us for additional areas. But look, at the end of the day, be clear on this point. The battleground, the key pivot point for the future is cathode active materials. Remember, you feed that with lithium hydroxide monohydrate, nickel sulphate hexahydrate, cobalt sulphate heptahydrate, and manganese sulphate monohydrate. Those chemicals are critical for high energy density cathode active materials. On the other side, it's lithium, and we'll use lithium hydroxide monohydrate. Then, of course, ferrous, which will come in the form of ferric sulfate or a similar chemical. That's straightforward. And then, of course, phosphoric acid. And we land in the Royal Commission of Yanbu or the Yanbu Industrial City. The largest producer of phosphate in the kingdom is, of course, Mardin. And we have a supply potential from that company in the kingdom.
I'm glad that you mentioned lithium, Michael, because I just wanted to get your insight on it. All of the EV metals took off last year. You're looking at what happened with copper, what happened with nickel, but lithium was just a rocket ship. What were the forces that really took it off in 2021, Michael?
Again, a good question. To some extent, you need to look historically. People have observed that the lithium bubble burst 2 or 3 years ago. It didn't really burst, it was a pause. The demand growth is there and has been, but of course, COVID intervened. There were, at that stage, oversupply of say, lithium product to market. The growth hadn't started really to occur in the battery cell, it's the battery cell manufacturing, electric vehicle manufacturing, and the growth outlook for those companies was less certain. It is now. I mean, we're looking at over $1 trillion committed to investment in the development of new electric vehicle companies or plants and battery cell manufacturing plants. And with that comes a demand growth profile, and that really is something that's really become apparent in the last 18 months. And yes, I agree with your observations. Those prices have increased. But again, we're going to take the view of an electric vehicle manufacturer here. This is about pricing points for electric vehicles for consumers. Consumers will determine the transition to electrification. You can make all the cars in the world, but if you don't have a consumer willing to pay the price for the vehicle, they're not going to buy them. Are you with me? So with that, we see the price as being very attractive. And this is where your commentary about Australia becoming aggressive. They are first movers, much like our Canadian brothers. I mean, we work in jurisdictions that are miner friendly. And we look at, for example, decisions that were taken over Rio Tinto's project in Serbia. I mean, I read a headline that said, the world wants more lithium, but it doesn't want more lithium mines. And look, you have a similar, if you like, confronting situation in the USA, for example, where, there are difficulties for mining companies. So when I come back to your original question about Australia being aggressive, it's for good reason. We can produce and deliver into the global shortages we see emerging in both lithium, nickel, cobalt in particular for these high energy density cathode active materials as well as lower energy density. So that's, I think, where we sit. The price is what it is. We have, as you know, made statements about transparent supply chains need transparent pricing. And we're working on offtake pricing models for offtake agreements that provide that to purchasers of high purity chemicals and cathode active materials. And that's designed primarily to provide an alternative to what amounts to prices globally. Look, let's step back. China controls 80% of the pricing of all intermediate products. So when you're looking at an intermediate product price, what price are you getting? The price that China sets. I'm not being critical of China here, but I think market forces are market forces, and where there's no alternative, that's the outcome. We're looking, therefore, at taking our business model and strategy to electric vehicle manufacturers and saying, look, this is what the supply chain looks like. This is how you get a long-term supply of critical raw materials. And here are the steps in the value chain around which we can control the margins to be able to give you a cost advantage in how you produce your electric vehicle. That's where the world needs to head, Michael, in our view.
On your website, you say you're committed to a clean energy for future generations. How will the plant be powered in Saudi Arabia, Michael?
Look, every one of our plants will be subject to our environmental, social, and governance policies. And that's work in progress. That's a really challenging, but really stimulating and inspiring place for us. So look, to answer your question in short, we're looking at hybrid power stations as a first stage. And the second stage, of course, is going to zero carbon or net zero carbon footprint across all our plants, both in Australia and in the Kingdom. Now, the Kingdom, this goes back to, again, a point you made earlier. Let's be clear about their position. We came to the Kingdom in 2019, and we were looking at building a nickel chemicals plant there. And of course, that's what led us to Vision 2030. Not a lot is well understood about Vision 2030 outside the Middle East countries. And I've been surprised by that. But look, this is how we saw it at the time, and I think it's very much the way it is now. Vision 2030 is a national strategic economic plan to transform the Kingdom from being a world leader in energy based on fossil fuel to being a world leader in energy based on renewables. Fossil fuels aren't going to go away, but the thrust of that strategy is clearly for them to move to a dominant position in renewable energy globally. And, our assessment would be that there are very few countries that have the political will and, more importantly, the capital to make that transition. And of course, we land in the middle of that, and we see the opportunity, of course, to work with the lead agencies whom we're now working with in that transition in a significant way.
I would think that Saudi Arabia would be challenged with the cost of labor, skilled expertise, just given what oil is doing right now. Is that a challenge, Michael?
It's interesting because we have started recruiting for the battery chemicals complex now. That's not our observation. If anything, the costs of labour that we're seeing are less than our expectations and less than what we're seeing in Western Australia, which, by the way, if you want to put it frankly, there's a huge demand for skilled labour here, and it's an issue for us in terms of costs. But that's not, the cost structure in the kingdom is not. We have not seen that. I think the challenge is this now. Looking at the kingdom's minerals and metals sector and the National Industrial Development Centre, who's our lead agency there, in the agreement we signed with them, asked us, in addition to building a battery chemicals complex, to participate in the development of the Saudi supply chain, which in essence means the minerals and metals sector of the kingdom. And this is not meant as any criticism at all. If you think carefully, when you're producing oil at a cost that Saudi does, selling it between $160 and $100 a barrel, over the last 60 years or so, the capital that builds up through that makes the minerals and metals sector look like small beer, to use our parlance. But the transition to renewable energy opens up a requirement for critical raw materials that contains strategic metals for the transition to electrification and to a clean energy future. So in that, we look to the kingdom and the expertise the kingdom has in the minerals and metals sector. It's largely an area that Martin, the state mining company, dominates to date, and they're a big company and a good company, but their business has been largely built on phosphate and aluminium, more recently moving into gold and copper. And of course, apart from copper and perhaps some phosphoric acid, the minerals and metals aren't there. So here's the issue for us. In developing the Saudi supply chain, we're in a position in Australia, and this is what excites us, to bring world-class leading technical capabilities, process technology, more importantly and most importantly, Michael, is know-how to the kingdom to accelerate the development of the Saudi supply chain. And with that, of course, we're already active in that area under the new mining investment law. I think we have between 80 and 100 applications. That's a part of our business strategy, but ultimately, people will tell you from the industry that it takes 5 to 10 years to develop a project. First to find it, then develop it. So in the interim, the kingdom, I think, has been strategic through EV Metals in targeting Western Australia as a supplier of intermediate product until the Saudi supply chain is developed. And I think we represent probably the first most significant investment by a Saudi company outside the kingdom. And they've come to a great place in Western Australia. So I'm in Perth and the sun is shining on my left. It's the end of Sutton, close to it. Michael, I hope that answers your question.
Michael, just to close on what are some of the milestones that EV Metals Group will be hitting over the next few years?
Very good question. So we have a team of engineers led by Wood PLC, their own engineering partner, and probably the best partner to have, given that they've built one of 2 lithium hydroxide monohydrate plants outside of China in the last 5 years, and that's not far from where I'm sitting at Kemerton. So firstly, finished feed by Q4 2022, commenced construction of the first 2 trains, Q1 2023. We should be looking to commission those first train of the 2 trains in the second half of 2024. The second train staggers the first train by about 6 months, so that land's being commissioned in 25, and we ramp up both plants 24, 25, 26 to look at producing 50,000 tonnes of LHM by 26, 27. The significant structural deficits in the supply of lithium chemicals to global markets occur after 25. So again, it's about fast-tracking development for speed to market. With that, you'll see interesting developments in the Australian Lithium Alliance, and in particular our joint venture agreement with Zenith Minerals. First cast strategic fit for us. So look for announcements around drill outs for spodumene deposits that will go to a spodumene concentrator to feed the first 2 trains of LHM coming out of Western Australia. Probably the most important milestone to look for, and it's an announcement that will, I think, be made in the next 2 months. Look for our announcement on cathode active materials. Board has approved us bringing that forward. You would expect it to follow nickel and lithium. We have a strategy now that will enable us to bring that forward, and of course that's a very important strategic development for our company. With that, there are others, but I think we'll keep it simple and leave it at that, Michael.
Michael, thanks for your time.
Always a pleasure. Anytime, anything you want to ask about what we're doing, please give us a call. Thanks, Michael.
He's Michael Naylor. He's heading up EV Metals Group. My name is Michael McRae, and you're watching Kitco Mining.